Get the latest Zacks research, analysis, and rankings on exchange-traded funds in Exploring ETFs. We're going to take a look now at Revenue Weighted ETFs with our ETF Research Director, Nina Mishra. And there's something a little different because typically the ETF industry is dominated by the market cap weighted indexes.
Yeah, you're correct. Traditionally, these larger market cap weighted ETFs, they dominate the industry. And they are fine for investors looking for a low-cost, convenient, and transparent way of replicating the market returns or a sector's return. They're absolutely fine. But at times, they are not the most efficient way of investing. And the reason is that as the price of a stock goes up and its market capitalization goes up, its weight in the index goes up. So these indexes and the ETFs, they buy more of that stock. And on the other hand, when the price goes down, its weight goes down, and then they sell that stock. So it's kind of buying high and selling low. So sometimes that doesn't work. And typically these larger companies, at times they are more expensive, smaller companies are cheaper. So you're focusing on larger overpriced companies at times. So that is why market cap weighted ETFs are not the most efficient way of investing many a time. And in the past, some other alternative weighted indexes like based on revenues or cash flows or dividends or on earnings, they have performed much better than these market cap weighted indexes.
So is that the reason we're focusing on revenue? Better performance?
Yes. I mean, many analysts believe that revenues are a better indicator of a company's financial health. And the reason is that earnings are easier to manage. And because of Wall Street's focus on earnings and earnings per share and beat and miss and all that, many companies use accounting tricks to flatter their earnings. On the other hand, revenues are more transparent. They are more difficult to manage. So probably focusing on revenues is a better way of focusing on better quality stocks. So I believe that revenue-weighted ETFs are one of the best fundamental weighted indexes that investors can focus on.
All right, so one example of this is the Revenue Shares Large Cap Fund.
Yes, the ticker is RWL, and this has the same securities as the S&P 500 index, but instead of weighting on market capitalization, it weights the holdings based on their revenues on the top line. Of course, companies like Walmart, Chevron, Exxon, Berkshire, they are among the top holdings. It charges 49 basis points in its expense ratios, has been around for a little more than 5 years, and has beaten S&P 500 index ETF significantly. It returned 185% in the last 5 years compared to 160% for S&P 500 ETF.
And Revenue Shares also has a small cap fund.
Yes, for investors looking at small cap companies, this is the ETF which they may like to consider. The ticker is RWJ, and it, like the large cap ETF, it also follows it has the same securities as S&P 600 small cap index, but holdings are weighted based on revenues. Pretty well diversified. Top 10 holdings account for just about a little more than 13% of the total asset base. Charges 54 basis point in expenses, and this also has performed very well. It returned 300% in last 5 years compared to S&P 600 small cap ETF, which returned 252%. Both of these ETFs are Zacks rank 2 or buy rated ETFs.
Okay, do you own either one?
No, I don't.
All right, we have more information on ETFs in the ETF section of our website, Zacks.com. Link to it right off the homepage. If you're not there already watching this video, get on over and check it out. With Nina, I'm Terry Ruffalo.